All right, so today is October 25th. We're going to continue on talking about Chapter 4. On last Thursday, we did do a little bit of an intro on Chapter 4. Started talking about that, and we're going to talk more about it. One thing I did want to point out, unfortunately, on the 1st, they're not going to be here again because, interviews that I'm helping out with. So that is a week from today. What I'll probably do, we'll kind of see how far we can get into Chapter 4. If we need to extend Chapter 4 discussion into the Thursday after, we can do that. So I do want to assure you we will get everything covered with Chapter 4, but on the 1st, November 1st, I will not be here. So you do not have to be here either. You can use that time however you see fit. Hopefully that, aside from the day during Thanksgiving week, hopefully that will be it for missing class. All right.
Class that Thursday.
I'm sorry?
It was just class that Thursday. No, that's Thanksgiving.
That, yep. Yep. So, yes. So, and I think I put that on here. Yeah, so I've got no class and no class on the 22nd and the 24th. So, but that's okay. We can, like I said, we can maybe, or if I have to finish up Chapter 4 and then start Chapter 5 on the 3rd, that's fine as well. Okay, Chapter 4 is really, you'll probably need more time. We'll probably need more time together to discuss Chapter 4 because there are so many aspects to computing that income tax withholding. Any questions about the schedule? Oh, okay. This PowerPoint's up. Hopefully they work this time. There we go. So we started to talk about fringe benefits a little bit. I want to talk about, I think we got to the first page of that fringe benefits discussion where we were talking about types of fringe benefits where that are subject to withholding and types of fringe benefits that are not subject to withholding. So with those fringe benefits that are subject to withholding, there are a couple of different ways that can be reported. So recall, that's when we've got some sort of fringe benefit that is added to our paycheck. We're not actually receiving the cash, but we're receiving the value of the fringe benefit, and it is subject to income tax withholding, even though we haven't received the cash. We could value the fringe benefits, withhold at what's called a supplemental tax rate. This is the same tax rate that's oftentimes used for bonuses. It's just a flat 22%. It's pretty simple to implement. Or we can value the fringe benefits and add them to the regular wages, treat them as one paycheck, and then withhold on the total amount of pay. There is the option to spread out the value of those fringe benefits over several pay periods. So instead of having, they've got an example here, country club membership, which would be taxable to the employee if they receive that. $2,000 value of that could add $500 to 4 separate paychecks. Okay, rather than being hit with that $2,000 additional income all at once. Okay, I wanted to, we're talking about a lot of different things here with regard to fringe benefits, what's taxable, what isn't taxable, how it affects the paycheck. And so I wanted to put up here kind of a little guide for you. So we've got kind of 4 different categories of items that may or may not affect income tax withholding. So we've got certain items that are deducted from pay. And then we have certain items that are added to pay or additions to pay. As well. Within this category of deductions from pay, we have pre-tax deductions and we have post-tax deductions. With regard to additions to pay, we have tax exempt additions and we have taxable additions. So how do these work? So with regard to the deductions from pay, anything that is a pre-tax deduction means that the amount is going to be deducted before we calculate the tax. Example, we've got, so here's a pre-tax example. We have gross pay of $1,000. Let's just say we're going to use this 22% tax rate. Okay. Pre-tax tax deductions would mean that we're going to subtract that deduction before we calculate the tax. And this becomes our taxable amount. Okay? So 800, if we were using the 22% rate, probably do that in my head, but let me. Whoops. So 176 would be our tax. If it were a pre-tax deduction. If, however, this $200 deduction, whatever it is post-tax, we're going to take the $200, we're still going to deduct it from our pay, but when we're calculating the actual tax, we're not going to take it into account. So we'd have the $1,000 times 22%. So $220 of tax is what we're paying here. Now at this point, we would then deduct these amounts to get what our net paycheck is. But you can see, I'm not going to go that far at this point, we will do that when we get into further calculations, but you can see the difference in the tax that's being paid. If it's a pre-tax deduction, it's going to reduce tax. Okay, we are subtracting that before we calculate the tax. If it's a post-tax deduction, it's going to increase that tax that is withheld. Now, what we're talking about here, deductions from pay, so these are amounts that the employee is paying. It's just that they're paying it from their paycheck. Rather than paying cash for something, they're paying it from their paycheck. So things like health insurance premiums, other medical insurance premiums, retirement contributions that the employee is paying. If they have other types of benefits, maybe they have signed up for life insurance through their employer, which oftentimes happens. Those premiums are being deducted from their paychecks. Those types of things, this is the employee is paying it. Okay, so any of these deductions, the employee is paying. Okay, employee pays. With regard to additions to pay, the employer is paying these. It's just that sometimes that additional amount is not taxable to the employee, but sometimes it is. Okay, so we'll look at 2 examples of that as well. Okay, so let's just say we have, again, so we've got tax exempt. And we're using a 22% tax rate. $1,000 gross pay. Let's say we have a $200 benefit. Somehow the employer is providing something to the employee that is worth $200. When it's tax exempt, we're not going to add that $200. Health insurance is a good example of a tax exempt benefit. So the value of health insurance premiums that an employer pays on behalf of an employee, as long as it's part of what's called a cafeteria plan, and most employers have those set up. The value of that health insurance is not taxable to the employee. Okay, so we wouldn't add anything. We just take the 22% of our tax rate. So $220 is our tax. Now, if we have a taxable benefit, same 22% tax rate, $1,000. Oops, I don't know where to put my decimals. And now we're going to add this taxable benefit, $1,200. Then we're going to multiply it by the 22% tax rate. Okay. 264. So you can see how if it's a tax exempt benefit, we're going to pay lower tax. We're going to have less withholding. And if it's a taxable benefit, we're going to end up with additional withholding, more withholding, and pay more in tax. Are there questions about the distinction between those 4 items? So what we've been talking about here, these fringe benefits, are additions to pay. Amounts that are added to an employee's pay, where they're not getting the actual cash, but they're getting some sort of benefit, and we're adding the fair market value of whatever benefit that is. And we went through a lot of those examples, so let's kind of back up and take a look at some of these examples again. So, subject to income tax withholding means it's taxable, okay? Non-cash fringe benefits, those tickets to athletic clubs, the value of those going to be taxable, added to an employee's pay. The value of frequent flyer miles, again, personal use of a corporate car, again, so those are all going to fall under this taxable category, where it's going to get added to the taxable pay. Specifically excluded fringe benefits, those employee discounts we talked about. Tax exempt, we're not going to add it to their taxable pay. The athletic facilities, as long as they are on premises, whatever the value of that is, those are tax exempt. That's also not going to get added to an employee's pay. Okay? Any questions about those items? When we're going to talk as well, I'm trying to remind myself here. No, we haven't talked much yet about these types of deductions, but we will. All right. No questions about that? Making that distinction? You guys are all very quiet, as usual. All right, so let's talk a little bit about federal income tax withholding on tips. Tips are taxable income. So the employer, and remember, the employee has to report those cash tips to the employer by the 10th day of the following month. Okay, so if it's over that $20, 20, 30. This says 20. For some reason I have it in my head that it's 30. Does anybody remember from the last? I thought that it changed. I could be wrong. Anyway, I'll double check on that. The employer then adds that amount when they calculate the federal income tax withholding that they're gonna do. They add the amount. Now it's from the last month. It's not from the current month, it's from the last month. So Kelsey, you mentioned that you wait tables. And so I would assume you have this type of system, are you? No, so you're probably in a small mom and pop type of.
Nope.
Really?
I work at Whiskey River.
At Whiskey River, so you don't report. What they probably do then is they allocate tips. They assume.
Based off of what I just read? Nope.
Okay, so they're not including any tipped income in your wages.
They do our credit card tips. Just our credit card
but
tips.
not the cash tips.
Right. We don't have to report our cash tips at all. Every waiting job that I've had over the last 10 years, we haven't had to report our cash tips.
Okay. Well, that's not the correct way to do it. How it's supposed to be done, those tips are, so if it's a large establishment, and by large they mean with employees that have more, or employers that have more than 10 employees, what the employer does is they essentially assume that the employee made at least 8% of their gross receipts in tips. That kind of gives an average for those cheapskates who don't leave any tips, or who leave really piddly tips, and those who leave decent tips, so that 8% amount. And this is called tip allocation. Now the difference between tip allocation and reporting actual tips is if actual tips are reported, then the withholding there is withholding on those actual tipped amounts. If tips are allocated, however, they're reported, but they are not, there's no income tax withholding. They're not subject to income tax withholding. Now, it doesn't mean they're not subject to income tax. I want to make this distinction really clear. Just because something is not subject to income tax withholding doesn't mean it's not taxable. It just means that that tax is not going to be paid at the source. It's going to be paid at a later time, probably either through an estimated payment or when the taxes are actually filed. Okay, so those allocated tips, we take the reported tips minus 8% of the gross receipts. So if, and it doesn't include the carryout sales, and if there is, sometimes they'll just automatically include a tip for parties of over 6, that sort of thing. That's not included in the calculation either. Again, employers not required to withhold taxes on those allocated tips, only on the reported tips. There are 3 different methods for doing the tip allocation. You can base it on hours worked, gross receipts, or some other type of agreement between the employer and the employee, as long as the employee understands what that agreement is, and probably best to get that in writing as well. But the tips are supposed to have withholding from them. All right. Questions about that? And maybe some of you as well have had a similar experience where if you've waited tables, they either have or have not. Usually it's the smaller businesses that what you find don't do that. Whiskey River is large enough that they probably should know how to do
Well, like,
yeah.
even when I worked in Applebee's,
Okay.
like, it asks you, like, at the end of your shift,
Mhm.
how much money you made in tips.
Mm-hmm.
And, like, most of the girls put, like, $1, $2, and they don't question it.
Well, and at that point, then if it doesn't equal at least 8%, they would be required to, they should add the 8%.
8% of the
Of the gross receipts, yeah. Like what,
Yeah, most of us did.
yeah. If you already made that, if what you reported exceeded that 8%, then they don't have to do that.
Oh.
Yeah, it's whatever is, whichever is higher between those two. So they have to assume that you're making something in tips. This is just to prevent individuals from not reporting any tips and not having any withholding on those tips. So that at least at a minimum they're capturing a certain amount of tips.
So then, like, we're all old enough in here. How are strippers supposed to?
They would also be required to claim those tips.
But how though? If they're considered independent contractors?
They probably shouldn't be considered independent contractors think back on our discussion about the difference between an employee and an independent contractor. It would go back to whether or not they're, who has control over their activities as a worker.
They do.
So they get to choose
Yeah, they choose
their
hours,
shifts.
they choose when they work.
Okay, well then perhaps they are independent contractors. In that case,
I think they have to pay the club to also dance there sometimes.
okay. Well, in that case, then they would be they're independent contractors, remember, so they would not be subject to income tax withholding because they're not employees. Only employees would be subject to the income tax withholding. That income is still subject to taxation though. It just means that the responsibility is now on them to report that income
Got
and
it.
pay tax on it.
Got it.
Mm-hmm.
Would it be considered tax fraud if they don't?
Yes.
Why do I feel like that's like a gray area?
I would imagine that no, there's really no. As far as the IRS is concerned, all income is taxable unless it's specifically exempt. Unless it's in the tax code that it is exempt from taxation. All income would be taxable. That would be taxable income. And not really, it could verge into fraud, certainly. But yes, it's taxable income.
I guess I just have so many questions because, well, not so many, but if that is considered taxable income,
Mhm.
then people on the street who receive tips or money from other people, that's not taxable?
Technically speaking, if they're receiving it, that would probably be considered a gift. They're not providing any type of service in exchange for it.
Okay.
And gifts are not taxable to the recipient.
Okay.
They are sometimes taxable to the donor if it exceeds a certain amount, but that certain amount is a very large amount.
Huh.
Mhm.
Interesting.
Yes.
Okay.
So, any other questions? Great questions, though. Okay. So, travel expenses. If an employee gets reimbursed for travel expenses, so an example of that would be, your employer sends you to a conference in, New Orleans, and they pay for your hotel, they pay for your transportation, they pay for your meals while you're there. That would be considered a tax exempt addition to pay. You're not going to pay tax on that as long as the employer has what's called an accountable plan. An accountable plan is simply it's a plan that the employer puts together specifying what types of expenses are reimbursed, what types of expenses aren't reimbursed. That accountable plan is it needs to be signed by the employee and the employer. It's not something that gets sent off to the IRS. It's just something that they have on file. They're pretty easy to put together. There are templates online for these accountable plans. So it's one of those things that there's really no excuse for an employer not to have one of these. But as long as that accountable plan is in place, it indicates that those types of expenses are reimbursed or are provided and paid for by the employer without the responsibility of the employee. Then that is not considered to be an addition to our pay that is taxable. It would be tax exempt. If there is no plan in place, travel reimbursements that are made under a non-accountable plan, which just means there's no accountable plan, would be considered wages. So if there is no plan in place, that would be considered taxable wages. Even though you're going there for your employer, they're sending you there, the value of that would be considered taxable and added to your pay. With the accountable plan, it makes it tax exempt additions to the pay. Okay. Now, one of the things, I guess, let me back up here for a second. With the travel expenses, sometimes what employers will do is they will give advances for travel expenses. So they'll just, let's say, here's $2,000, you make the arrangements, this is to cover your hotel and your plane ticket and all of that stuff. If it is more than enough to cover all of those expenses, and the employee is not required to give back any additional amount, then the amount of the difference between what their expenses are and what the payment was, that amount would be taxable to the employee because it wasn't used for the purpose that it was intended. In that case, that amount should be included. So for example, the employer gives you $2,000, you spend $1,700 on hotel, plane ticket, conference fees, meals, rental car, all that stuff, $1,700, and you get to pocket the additional $300. That $300 is taxable. Okay. All right. So certain payments that are exempt from withholding. Payment received by church ministers for their services are exempt from withholding. That doesn't mean it's not taxable, it just is exempt from withholding. Again, those advances for travel and other business expenses, I just mentioned that. If, however, the expenses themselves are less than what the advance was and they're not required to pay it back, that would make that additional amount taxable. Educational assistance, if it maintains or improves job status, so for example, CPAs have continuing education requirements, and the employer is benefiting from that individual being a CPA. In order to maintain their license, they have to take that continuing education. The value of that is not added. That would be a tax exempt addition to pay. There's another category of education expenses, however, that are not related to the job. The employer can pay up to $5,250 a year of tuition assistance. This is where, say you're working at principal and you're working in, I don't know what kind of departments they have. You're working in the human resources department, but you want to go back to school to become an accountant. Well, accounting isn't required in human resources, but principal helps to pay for any type of higher education. They can pay up to $5,250 a year and it will be tax exempt. It does not get added to the employee's taxable income. In addition now, and I don't know if this is a permanent feature or temporary, if the employee, instead of $5,250 a year for tuition assistance, the employer can provide up to $5,250 a year for payments toward an employee's student loans. So you can find an employer that'll help pay for your student loans. That's a great thing, and the first $5,250 would not be taxable to you. Moving expense reimbursements for active military, we already talked about that a little bit. Transportation expenses. So, and by the way, these are, I don't know if the $5,250 is going up. I know this is going up to $300 a month in 2023. Transportation. So, especially in big cities, a lot of times employers will provide maybe light rail passes or bus passes or things of that nature. DMAC provides free, and I don't know, maybe it's DART that's paying for it, but you can, the busing, the Des Moines, yeah, you can get free busing with the Des Moines area regional transportation, right? The value up to $270 a month for an employee is not considered taxable. If it's more than that, then the amount over that would be considered taxable. Now, in a place like Des Moines, you're not gonna find more than $270 a month for commuting expenses. That also pertains to parking as well. So if the value of the parking is more than up to $270 a month, would not be considered additional income, additional taxable income to the employee, okay? So these next few pages, I'm just gonna kind of zoom through here, see if there's anything that I really want to talk about. I already talked about the educational assistance, dependent care assistance. Dependent care assistance, employers can offer dependent care assistance where the employee actually, well, the employer helps to pay for that dependent care. So usually with like childcare and that sort of thing, up to $10,500 is not included in the employee's gross income. There's also dependent care assistance where the employee contributes to a fund for dependent care and then uses those funds to pay for dependent care benefits. Let's see. We're talking about the parking. Group term life insurance. I think I may have mentioned this at one point, but just to kind of reiterate. So employees, oftentimes employers will provide a group term life insurance benefit to employees. It's super cheap. It's a pretty inexpensive benefit that they can provide to employees, as long as the benefit to be paid, that's the amount if you die that your beneficiary would receive, is less than $50,000, then none of the premium that the employer pays on your behalf is taxable to the employee. Once the amount of the life insurance benefit exceeds $50,000, then a portion of that premium would be considered taxable income. And oftentimes those benefits are based on some multiple of the employee's regular wages. So one times their annual wages, 2 times, 3 times their annual wages. And so, you know, it can be fairly easy to get up above that $50,000 mark. And again, that's just the amount, the cost of the premium that then is added to an employee's taxable wages. Let's see. Living expense, we already talked about that. Retirement and pension plans. So if the employer contributes toward a retirement plan on behalf of the employee, the retirement plans are kind of a little bit of both, by the way. So they have a addition to pay component and a deduction from pay component. So retirement plans, the amount that the employer pays would be considered tax exempt additions to employees' pay. But if the employee also contributes to the retirement account, as oftentimes happens, you'll have an employer contribute portion and the employee contribute a portion. For income tax purposes, that is considered to be pre-tax and it reduces their taxable income. Okay? That is not how it is for Social Security and Medicare tax, however. Social Security and Medicare tax does not, those contributions are considered to be a post-tax contribution. They don't reduce Social Security and Medicare tax. All right. So now we're going to talk a little bit about these pre-tax and post-tax. Stop this for a second.